Pause the celebration for a moment. Because when silver punches through the $100 mark and gold is hovering just shy of 5,000, that's not just another strong week in the markets. That's a flare fired into the sky. That's the market shouting that something deep below the surface is shifting, and it's shifting fast. And if you don't understand that shift, you can still get blindsided, even if you think you're positioned on the right side. I'm recording this on Monday morning, January 26th at 6:20 a.m. New York time. Drop a comment with the time you're watching this, because I genuinely want to see how far this message travels. And real quick, YouTube analytics keep showing me the same thing. A lot of you are watching, but not subscribing. If you want me to keep breaking down markets without the fluff and the hype, hit subscribe and support the channel. If you're new here, I'm John A.G. Every week, I take the loudest market story, strip away the nonsense, and explain what actually matters, and what might be coming next. And right now, the metals market is doing something it almost never does quietly. It's moving in a way that pulls in three very different groups at the same time: long-term hedgers, industrial buyers, and short-term momentum traders. When that happens, opportunity shows up, but so do traps. And we're about to see both. The headline everyone saw was obvious. Gold surged to within reach of 5,000. Silver pushed above $100. Copper is quietly creeping toward its own all-time highs, almost stalking them. But what most people missed is why this move is happening now. This didn't happen in isolation. It happened while massive pools of global capital are openly questioning what safe actually means. And when that psychology changes, metals don't just move higher, they get repriced. I saw a clip circulating where a commentator casually said, "Gold is right there, silver hit 100. But the key detail wasn't the price, it was the timing. This wasn't supposed to happen yet. And when a market move shows up early, it tells you pressure has been building long before the crowd noticed. Right on cue, we started hearing reports of large investors trimming exposure to long-dated government bonds. A major overseas pension fund hinted at reducing treasury holdings. Other institutions in the same region talked openly about reassessing U.S. assets altogether. And one large emerging market country has quietly reduced its treasury holdings to the lowest level seen in years. Does that mean anyone is dumping America overnight? No. But it does mean something important. The assumption that long-dated government debt is the default safe haven is being questioned, publicly and in real time. And once that question is asked out loud, the market starts searching for alternatives. That's where gold enters the picture. That's where silver follows. And that's where copper joins in, because copper doesn't care about politics or headlines. Copper cares about wiring, construction, energy, and power. Quick reminder, check the description below. There are bonus links there, including access to a premium WhatsApp channel and channel memberships. That matters, especially when markets start moving like this and deeper updates become critical. Now let's talk about the dollar, because this is where people oversimplify and get sloppy. You've probably seen the chatter. Dollar weakness, pressure against the Swiss franc, and the idea that a weaker dollar automatically fuels commodity prices. That's sometimes true, if everything else is equal, but right now, nothing is equal. Metals can rise even with a firm dollar if real yields are falling, if trust in financial systems is eroding, or if global uncertainty is rising. Gold is not driven by a single variable. Silver definitely isn't. So when someone tells you dollar down equals metals up, that's not analysis, it's a shortcut. And shortcuts are dangerous when volatility picks up. Here's the better framework. Governments are trying to juggle three brutal forces at the same time: growth, inflation, and debt servicing. Push too hard on growth and inflation runs hot. Clamp down on inflation and growth stalls. Let debt servicing costs rise too much, and governments start bleeding cash just to pay interest. So policymakers try to thread the needle. They talk tough, then soften. They tighten, then hint at easing. They protect the system. And historically, that usually means real purchasing power gets sacrificed over time, because it's the least politically painful option. That's why the debasement narrative keeps coming back. Not because it's trendy, but because incentives don't change easily. And recent data on deficits and interest costs shows that pressure isn't easing, it's intensifying. Now layer geopolitics on top of that. Trade routes get disrupted, export controls appear, energy agreements get renegotiated, alliances shift, and every time that happens, markets stop pricing a smooth, efficient global system and start pricing a fragmented, unstable one. And fragmented worlds tend to reward hard assets. So the big question becomes, is it too late? Here's the honest answer. If you're asking because you want to buy today and sell next week for a quick flip, then yes, it might be too late. This market can punish impatience. Silver can rip higher one moment and collapse the next. $10 moves up, followed by $15 drops, are not unusual here. But if you're asking whether it's too late because you see metals as a long cycle response to broken incentives, rising geopolitical stress, and fragile supply chains, Then the real question is how much of this repricing has already happened and how much still lies ahead. Long cycles usually start with disbelief. Then comes acceptance. Mania arrives much later. Right now, we're not seeing mania across the public. We're seeing curiosity. We're seeing attention. We're seeing people wake up. That's not the end of a cycle. That's the crowd just beginning to show up. I've also seen comments from senior figures in the minting industry saying variations of, "This isn't a trade, it's a structural shift." I'm not quoting anyone directly, and I'm not asking you to take that as truth. But the idea matters. If the way the world thinks about money is changing, metals stop being just charts. They become a referendum. Here's the part most people ignore. Even if the long-term story is right, the path can still be brutal. You can be correct and still lose money if you're over-leveraged, overconfident, or operating on the wrong time horizon. That's why I separate two conversations: metal as insurance and metal as speculation. Insurance doesn't care about daily prices. It cares about trust. Speculation lives and dies by short-term liquidity, and it gets punished when that liquidity disappears. Now let's focus on silver, because silver is what's grabbing attention. Silver crossing $100 isn't just a price milestone. It's a psychological one. It tells the market that silver has finally stepped out from under its old ceiling. Once that ceiling breaks, market memory resets. New buyers stop anchoring to old highs and start asking a different question. What's next? The question alone can keep momentum alive longer than skeptics expect. What makes silver even more interesting is that it's not just a monetary metal, it's deeply industrial. Demand isn't just coins and jewelry, it's electronics, medical equipment, soldering, chemical catalysts, solar panels, power grids, and data centers. Every new grid upgrade uses silver. Every electrification project uses silver. And unlike gold, silver gets consumed in tiny amounts that often aren't economical to recover. Supply isn't as flexible as many assume. Now, the skeptical counterpoint matters. Industrial demand doesn't guarantee higher prices forever. Recessions can slow manufacturing. Inventories can get liquidated. That's why silver becomes explosive only when industrial demand and investment demand rise together. That balance is what I'm watching. First, the gold to silver ratio. When silver leads, that ratio compresses fast. Recently, we've seen levels around 50 ounces of silver per ounce of gold, a major shift from periods when silver lagged badly. Second, physical premiums. Are buyers paying extra for immediate delivery? Are premiums rising even with high spot prices? Those signals matter. Third, the broader commodity complex. When silver moves alone, it can be a bubble. When multiple strategic materials move together, it suggests a structural repricing. And right now, multiple materials are moving. In some parts of Asia, silver has been trading well above $100 locally, sometimes closer to the mid-100s. That gap tells you something. It points to localized demand stress, supply frictions, currency effects, taxes, and shipping constraints. Markets aren't uniform, and when prices diverge like that, it matters. Now, about the paper versus physical debate. Futures and leverage can push prices around in the short term. No argument there. But paper dominance only lasts as long as physical supply remains comfortable. Once physical tightens, reality takes over. That's why I watch small details. Longer delivery times, rising premiums, certain bar sizes becoming scarce. Those are signs that the move isn't just traders chasing charts. And here's something most people forget. Higher prices don't always destroy demand. Early in a repricing cycle, higher prices can pull demand forward. People buy sooner because they fear paying more later. That creates feedback loops. So don't just watch charts, watch behavior. Now let's talk about copper, the quiet sleeper. Copper isn't a panic buy. Copper is a the world is building signal. It's the wiring behind electrification, infrastructure, and industrial growth. Copper's problem isn't geology, it's time. Mines take years to permit, build, and ramp. New deposits are generally lower quality, meaning more rock needs to be moved for the same output. When analysts warn about copper shortages, they're pointing to a real constraint. And copper shortages don't stay confined to copper. They ripple through everything: power lines, transformers, EV charging, appliances, construction. Zoom out even further and you see the pattern. Uranium strengthening again. Lithium rebounding sharply after collapsing. Specialty materials suddenly becoming national headlines when restrictions appear. Restrictions don't guarantee permanent shortages, supply adapts, but they do create violent price swings because markets price surprises, not averages. Processing bottlenecks make this worse. Mining isn't the choke point, refining is. That's why certain regions wield outsized influence over supply chains. When concentration meets rising demand and political leverage, prices move fast. So what do I do with all this? I focus on function, not hype. I ask 5 questions. What does the world physically need more of? What takes a long time to supply? What's hard to substitute? Where are processing bottlenecks? What's politically sensitive? Run those questions, and you keep landing on the same materials. Gold, silver, copper, uranium, lithium, and key alloy metals. This isn't about betting everything on one trade. It's about understanding where pressure is building. And here's the real cliffhanger. The biggest risk right now isn't that the metals thesis is wrong. It's a liquidity shock. In real panics, people sell what they can, not what they want. That includes metals. That's why risk management matters. Final takeaway, this price action is both a warning and an opportunity. Volatility is coming. But when complex repricings begin, they often last longer than the crowd expects. Stay sharp, respect risk. Don't chase blindly. Watch the macro signals. Thanks for watching. I'll see you in the next video. And remember, this is educational content, not financial advice. Do your own research and manage your own risk.